Joining us is Rusty Vanneman. He's a Chief Investment Officer at Orion Advisor Solutions. Rusty, so the question here now is, if we do move past this geopolitical stuff, which market are we going back to? The dynamic of Fed cuts, which are now priced in again apparently, and high growth stocks, or positive economy in cyclical stocks?
We are positioned towards cyclical stocks.
Okay.
We think that it's risk on, and we think the rotation that we saw in the fourth quarter last year will be sustained into this year. What
will be the determining factors for that? Do you have to see big surprises to the upside in the U.S. data, or is it good enough to show a little bit of, slowness as long as the rest of the world does better?
Maybe it's just a little bit about investor sentiment, and finally kind of that wall of worry that was in place last year is finally going to get chipped down a little bit, and there'll be a kind of a risk on that we'll see. I actually think one of the most important charts, and you show a lot of great charts to get started there. The one chart that I think is like really key right now is looking at the U.S. dollar. I mean, that chart broke down, and what that means, a weaker dollar, it really suggests a rotation of a lot of different things. It means international stocks should outperform domestic. It means real assets could outperform. It could mean value stocks outperform growth. So that's kind of the key chart for us, and we think that investor sentiment kind of shifting is going to be kind of one of the big catalysts for how the market moves in this year.
I'm with you, Russ. We've been watching this chart very closely as well. That said, though, at $97, it almost looked like the dollar kind of bounced again around this trend of higher lows. What's the price, or is there an area at which it really will light the fire under international equities?
Oh boy, it's kind of that. There's not a certain level in mind. I think when it comes to the dollar itself, I think there's a handful of things you can look at in terms of evaluating the dollar, and almost all of them are sloped towards suggesting the dollar is going to get weaker. The technicals clearly suggest a weaker dollar. Sentiment right now suggests more dollar weakness. Longer term purchasing power parity type stuff, which is terrible for short term, does suggest the dollar could get weaker. The deficit's getting larger, turning the wrong way, suggests a weaker dollar. The only thing is interest rates in the U.S. are still higher, but I think the evidence is skewed towards a weaker dollar. And I just think that's the way to tilt portfolios, particularly for longer term investors.
One way you like to express that is through emerging markets. I'm looking at your notes. PXH is the Invesco ETF that you suggest looking at. A lot of times you use EEM as a very popular one. Is there a particular reason for the preference in the choice of fund?
What's really interesting, when you look at value versus growth, so when we think about the U.S. market, value is cheap versus growth. But when you look overseas, value is really cheap versus growth, and that's particularly the case in emerging markets. We think the emerging markets as an asset class is very attractive, but if you kind of put that value overlay on top of it, it's just a lot more attractive. So for instance, when you look at emerging market value stocks, it depends on the valuation measure you look at, of course, but a lot of them are roughly 1/3 of what the S&P 500 is. That's just remarkable. You have similar expected growth rates, but you have 1/3 the valuations. I think expected returns are far more attractive. The U.S., we've been in a bull market for a long time. We think actual returns are most likely going to be positive this year, but you really have to think returns will be below average in the years ahead. If you want to enhance returns, I think you've got to go international, and particularly with emerging market value stocks.
Okay. If you look at right now, the data continues to be beating expectations at a better rate in places like China and Eurozone versus the U.S. I guess the relative strength story is one. Does it need to continue to push that dollar lower? Do we need to continue to see surprising strength out of some of the weaker areas of the world the past year?
Yeah, that's definitely going to help. It's definitely going to help. You need some better earnings data coming out from the emerging markets, but the weaker dollar is probably the primary driver at this point.
Okay. One other thing here that I think is interesting, when you look at how to put these views on, you mentioned VLUE, the fund we talk about a lot here as well for value. One, though, in terms of looking at a thematic technology, the fund XT, tell me about this. Why do you like it?
Yeah, this is a little bit of a curveball even for us, but I think it's really interesting is that when you look at thematic exchange-traded funds, what's really interesting about that space is, well, first of all, they've had higher growth rates than generic exchange-traded funds. And there's a reason for it, is that some of these investment themes people can kind of grab onto and understand. And when it comes to XT, it's kind of looking at these disruptive technologies and some other sort of mega trends that are going on out there. And what's really interesting about these thematic ETFs, that they're kind of a way to get a satellite exposure to disruptive industries you can't get through conventional portfolio construction. The other thing about thematic ETFs, which is interesting, is that on a standalone basis, some of them can actually be a little more volatile in the overall market, but they kind of zig when everything else is zagging at times, and so you kind of get this additional portfolio diversification benefit. So again, for longer term investors who are trying to get sort of like this niche exposure, it's kind of a neat way to get it. And we're actually big fans of XT.
Now, lately we've seen this push back into some of the higher valuation growth stocks that suffered in the fall of 2019. Is that part of your fund as well? Is that part of the thesis for wanting exposure in tech, or is the cyclical conversation we started off here one that's more opportunistic at this point?
It's definitely much more looking for the opportunities. It's not really your conventional tech. It's not the FANG stocks. I mean, XT is pretty diversified. I mean, the top holding is Tesla. You just talked about how great that's performing, but really, that fund is very, very diversified. And I think Tesla is like 60 basis points. So again, it's just a diversified exposure on disruptive technologies in general, not necessarily some of the big technology sort of names that we typically talk about.
Yeah, and as you mentioned, an equal weighting across the board, right? So there's not a huge skew towards one of these companies where Tesla could turn around, but you've got Western Digital, AMD right behind it in terms of weightings as well.
That's correct. Yeah.
All right, Rusty, really good stuff. Really interesting take care, like the funds as well. Always appreciate the specifics. Mr. Vanneman is the Chief Investment Officer at Orion Advisor Solutions.